Hello, fellow Rebel Capitals. Hope you're well. I am back with my good buddy, Rick Rule, and we are going to talk about commodities, among many other things. So, Rick, welcome back to the show, buddy.
Pleasure. Thank you to have me back. And once again, a shout out for a great Rebel Capitalist conference.
Yeah, that was a lot of fun. We were just talking about that before we hit the record button. And the Rebel Capitalist community, you can't beat them. They're just incredible peeps, that's for sure. But one thing the Rebel Capitalist community is really interested in is gold, my friend. So I want to talk about gold. I want to get your opinions on that. And then I also want to go into the gold miners and the gold miners versus silver, because there's this, what I call a catch-up trade, where gold runs and then silver catches up, then exceeds it by 4 times or whatever. And the gold miners typically do the same. But I'm just wondering if you think this cycle will play out and maybe the mechanics behind why that typically occurs.
Happy to do that. Where would you like to start? That's a big topic.
Yeah, let's start with gold, because I think everyone should have gold as a portion of their portfolio for just insurance and no counterparty risk. But I know a lot of people buy gold because they want to increase their purchasing power. So what do you think about gold's return versus, let's just say, the CPI over the next 3 years?
Let's do the historical context first.
Okay.
Gold traditionally has done well when people are concerned about the maintenance of their purchasing power in fiat denominated instruments. And I would suggest that people have reason to be fearful. The gold trade, despite the fact that, as you suggest, gold has done fairly well in the last 2 years, the gold trade has worked since 2000. It's important to know that. Gold has been up 9% for 25 years, which goes to your suggestion that it maintains purchasing power. In terms of the route forward, I think it's important to note that gold is still a very uncrowded trade. According to JP Morgan Chase, less than 0.5% of the savings and investment assets in the United States are denominated in precious metals or precious metal securities, with a 4-decade mean of 2%. So reversion to mean would give us a 4-fold increase in demand. Let's get away from that part of the math, though. Let's talk about the why. It is my belief that with the on-balance sheet liabilities of the U.S. government now exceeding $37 trillion, for reference, George, the gross federal budget, all the money that Fed takes in, is $5 trillion.
The Treasury takes in, yeah.
Yeah, I mean, and the off-balance sheet liabilities, which are much scarier, Medicare, Medicaid, Social Security, federal pensions, that number, the net present value of unfunded entitlement liabilities, exceeds $100 trillion. It's my belief that the only way out of the debt and the deficits that we run is either an honest default, which I don't think is politically likely, or a dishonest default. A dishonest default, George, is what we did in the 1970s. The government allowed the purchasing power of the US dollar to decline by 75% over 10 years, which meant that while they honored the nominal value of obligations incurred prior to 1970, they paid them back with 25-cent dollars. Not coincidentally, in the decade of the 70s, when the purchasing power of the US dollar declined by 75%, the gold price increased by a nominal 30 times. I'm not suggesting to you, by the way, that the gold price is going to go up 30-fold in the next 10 years. I am suggesting that in the next 10 years, the purchasing power of the US dollar declines by 75% again. I think that's inevitable. Remember that since the year 2000, the gold price has gone up 12-fold already. It wouldn't surprise me to see the gold price increase mirror the decrease in the purchasing power of the US dollar. Ergo, if the purchasing power of the US dollar declines by 75%, the gold price over 10 years could easily increase 3 or 4-fold in nominal terms.
Yeah, that's the key though, Rick, right? Because if it's nominal terms and you sell, then you take a tax hit and you're actually not maintaining your purchasing power.
You are maintaining your purchasing power much better than were you in almost any other asset class on the globe. Yes,
Right.
I get it. There is no perfect answer. The truth is, and by the way, I'm no long-term pessimist. I think we get through this. We got through the decade of the 70s, but there was a reckoning. people who weren't prepared, people who believed that their pension in 1970s dollars was going to sustain their lifestyle in 1980 had a very hard decade. People who owned long-term treasuries, 30-year treasuries that yielded 4% when the new treasuries yielded 15, had a very, very tough decade. We will get through this, but there's going to be a reckoning. And the rebel capitalists need to pay attention to their common sense, not pay attention to the rhetoric or the information that they get from some aspects of the mainstream media.
Yeah. And I've got a slightly different view because as we've talked many times, I don't know that the treasury market is a problem due to demand, but I don't want to go too far off topic. But I do believe that the next decade or the decade of the 2020s, let's say, it sounds crazy to say the next decade, we're halfway in the middle here. But I do believe it's going to be, we'll look back and it'll be an inflationary decade, very similar to the 1970s or the 1940s. But I think it'll be more like the 1940s. I don't know that, the Fed's balance sheet will probably increase. I don't know the impact on M2 because of what global banks are doing. But I do think we will see bouts of inflation. I think we'll see bouts of disinflation. We might even see bouts of deflation, but I think it'll be because of the government interference in the economy and more so supply shocks and price controls. And that's why I go back to the 1940s as opposed to the 1970s. But the net result, bottom line, is still it's still the exact same. And is there also a premium for gold, not just to maintain the purchasing power, but also to have purchasing power outside of the system where there's no counterparty risk? Because I think that's why we're getting such a huge bid, especially with the global central banks.
Well, that's a different point, perhaps a new point, but a very real point.
Yeah,
The U.S. government and U.S. society, for better or for worse, has weaponized the U.S. dollar.
right.
There are some, quote, patriots in this country who think that's a good thing. I'm not among them. But in terms of the rest of the world, the efficacy of their maintaining their medium of exchange in a currency that the U.S. government, should it deem to, can impound is
Right.
problematic. Whether or not you agree with Russia's decision in the Ukraine, there is no doubt that the U.S. government stole $300 billion worth of Russian assets in the United States. That causes other countries that may have policy disputes with the United States concern. As little as they trust each other, I've come to learn they trust each other less. So
Right.
the idea that the renminbi or the yen or the euro or the BRICS could become the world's clearing currency doesn't work. I think the US dollar, in fact, will remain the reserve currency for the world. But I think US dollar hegemony will decline. And I think the prime beneficiary of that, or among the prime beneficiaries of that, will be gold. And by the way, I'm not suggesting that one denominate one's whole life in gold, but I think gold's market share, 1/2 of 1%, is ridiculously low.
Yeah, right. Yeah, and I want to go into
Ridiculously
that a
low.
little bit more, Rick, because just so people are kind of following what you're saying, and correct me if I'm wrong, but I think the majority of this price move we have seen from, let's just say 1800 to 33 or 34 is a result of the central banks buying, not necessarily retail. And I think that retail buying is actually quite low. And I would assume, based on those numbers you gave, institutional buying is quite low as well. So I think it's a given, or it's as close to a certainty as you can get, that the central banks will continue doing what they have been doing because the incentive is still there. But the question is, when does retail come aboard and when do the institutional buyers come aboard? What is usually the catalyst to for them to take action?
By the way, the statistics bear you out. The retail buyer, judging from positive cash inflows to bullion denominated ETFs, began about 20 weeks ago. The
Okay.
move that we have seen from 1,800 to $3,400, as you suggest, has been largely central bank buying.
Okay.
The bullion dealers in this country are delighted merely to see a bid, and so they will regard to you that volumes are surging, but volumes are surging from a pathetically low base.
Mm,
So what you say is exactly correct. Uh, I mean, exactly correct. It's important to note that on a global basis, gold's market share, that is to say, the market share of precious metals and precious metals related securities, is at about 1%. It's double US levels. The suggestion is that that occurs because institutional investors, retail investors, other people don't have access to as many opportunities as investors do, as investors in the United States do. And I think that's as good an explanation as any. In answer to your question, what would cause retail participation?
Yeah.
I think an engineered decline in the interest rate,
Huh.
where savers and investors in the United States and abroad come to understand that US society, at least as expressed by the political class, has no interest in maintaining the US dollar, would be a catalyst. We have an economy that, according to the big thinkers, is in pretty good shape. I mean, if you happen to be a Democrat, you think that the economy is Biden's creation,
Yeah.
all that kind of stuff.
And if you
But
don't think it's in good shape, Rick, you'll just get fired.
well, that's true. But the truth is, as an example, the VIX is at a very, very, very low level. There's not much
Yeah.
volatility in the market. There's a lot of near-term liquidity in the market. The idea that we need to cut the interest rate now isn't borne out by economic statistics, but it's politically expedient to lower the interest rate, particularly given the cash interest on US debt. If the political class decides to lower the interest rate, manipulate the interest rate down, I think that'll be a signal to investors and savers around the world that US society has no expressed interest in maintaining the purchasing power of the US dollar. In other words, we will be admitting the obvious. And I
Mhm.
think that'll be a tremendous catalyst. It'll certainly be a catalyst for me. George, if a financial planner looked at my accounts, if they looked as an example at the fact that I'm the leading shareholder of Sprott, which is in effect a brand name for gold, they'd say, you know what, you're out of your mind owning physical gold. Your whole life is leveraged to gold. You don't need any more gold. But the truth is, it makes me sleep nights and stay calm. And I think that feeling may spread fairly significantly if they engineer a decline in interest rates. It looks to me like interest rates left to their own devices would like to go much higher. The idea that we manipulate the short end of the curve, which traditionally has worked in terms of long-term rates, but long-term rates, the 10 to the 30-year rates increase, tells you that Mr. Market, as expressed by the bond vigilantes, don't trust US society any longer to maintain the purchasing power of the US dollar.
Yeah. Well, I mean, the 10 years still, I think today it's trading below Fed funds.
Right.
So I don't know that we have a demand problem at the end of the curve, but I do think that number one, gold has been, and correct me if I'm wrong, but the best asset. I think it even outperformed the S&P 500 going back to 2000. And so I think that there's going to be incentive for people to continue, not just inside the United States, but outside the United States as well. But again, I take a little bit different approach and I look at it as just the counterparty risk that's involved in the
Right.
financial system, for
Right.
heaven's sakes. I mean, set the inflation aside or interest rates or any of that. There is so much insanity going on in the world right now that you look at your portfolio. I mean, stocks are at an all-time high. I mean, you could argue that bond prices are going to go down. Uh, Housing prices, real estate, it's at all-time highs in a lot of places. And so you look, I mean, what are you going to do? You're going to buy crypto? You're going to buy fart coin? I mean, okay, maybe, but that's kind of taking a flyer.
Yep.
And you kind of come to the conclusion that, look, if I want to sleep well at night, to your point, then I've got to have some gold. And then if I want to really kind of turbocharge my purchasing power, if I believe that gold is going to go higher, then we go over to the gold miners. Or do we go over to the gold miners or do we go over to silver?
I think that depends on who you are. For me, my physical gold holdings are all about maintaining my purchasing power.
Right, right.
That's what it's about. I've done an interesting exercise, George, beginning in the year 2000. I tried to reorganize my mind and my financial future in the year 2000. It seemed like an interesting exercise to do. And I've maintained a separate private ledger where I annually measure my income, my expenses, my net worth, my investments in gold terms as opposed to dollar terms. I live in dollars, but I've
Right.
tried as a thought exercise to think in gold. And if you think in gold in the period 2000 to 2025, you're amazed at how cheap housing is. You're amazed at how cheap groceries are. You're
Yeah.
amazed at
S&P
how cheap
500 would be cheap.
it is. Gold has increased at 9% compounded for 25 years. And I think that reality probably begins over time to creep back into the equation. Remember, too, that I'm not talking about massive disintermediation out of US dollar denominated assets. I'm talking about reversion to a 40-year mean.
Hmm.
I'm talking about the market share of gold climbing back up to the average market share in the period 1982 to 2022, which is 2%. JP Morgan Chase doesn't have data from 1981 or 1982, but they said that they surmised that the market share of gold relative to other asset classes at gold's peak, 80,
Right.
81, 82, was between 6 and 8%. I'm not suggesting that gold reverts, even in a nominal sense, to its peak valuation. I'm just suggesting to you that that asset class, precious metals and precious metals equities, reverts to the 4-decade mean. You can imagine, George, you have a better knowledge of the intricacies of markets than I. You can imagine the increase in nominal price that would be generated by a fourfold increase in demand.
Yeah.
Now, let's move on to the gold stocks.
But,
If you
but
look at the
Rick, I
past,
just want to say one thing there, but correct. But the scary thing there is it could go the opposite way. And what I mean by that is it could revert back to the mean, not by the gold price going up, but the price of all their assets coming down.
if you're talking about the idea of a deflationary depression, that is something that people need to be
Or at least
concerned
with
about. This is
assets. I
why
mean, you look at the
portfolios
GOP,
need to include liquidity in whatever form
right?
the portfolio holder feels is appropriate. Certainly, the event that I talked about in what I guess we'd call the opening monologue here, uh, the impact of debt and deficits on private and public balance sheets. The resolution of that, an honest default, is extremely deflationary. Thus far, the way that the political class has managed the risk of default is to flood the system with liquidity and devalue the dollar. If for some reason they gave a treasury auction and nobody came, if we couldn't extend and pretend, then the circumstance that you talk about, a deflationary collapse, is something that people need to consider. Absolutely need to consider. I personally believe it's unlikely, perhaps simply because I don't want it to come true.
But
uh,
I think that you can have consumer prices, the price of stuff, goods and services going up while you have a deflationary collapse in asset prices. So,
we had
as
that
an
in the decade of the
example,
70s.
1940s too, Rick. I just did kind of some research yesterday because everyone always says buy the dip because the S&P 500 goes up all the time. It's just over time it always goes up. So I actually
Right,
wanted to put that to the test. So I looked at the S&P 500 going back to 1930, adjusted for inflation.
right.
And you see that no, it doesn't always go up. In fact, there were 4 decades where it went down, and there were 4 decades where it went up, and there was 1 decade where it was flat. So it's basically a coin toss. But I wanted to point out that the 2 inflationary decades that we've had, the 1940s and the 1970s, the S&P 500 in real terms went down. And in
Right,
the
that's correct.
1970s, it went way down. So that's kind of what I'm concerned about. I think what people need to think through.
I completely concur. I don't want to opine on the price levels of the S&P 500 simply because I only have valuation skills around natural resource and conventional financial services stocks. I'm not prepared to tell you that NVIDIA, however you pronounce it, or the other tech stocks are too expensive or too cheap. I don't know how to value them.
Right.
So I wouldn't want to opine on that kind of thing. I would comment that that so-called Buffett indicator, which is to say the level of the S&P 500 relative to GDP, is at levels that concern him. And he's smarter than me. So if he's concerned, I'm concerned. That's as far out of my little natural resource and conventional financial services ghetto as I'm willing to get. But I certainly take your point. I came into financial services in 1974. I remember very well how difficult it was for young stockbrokers to deal with an equities bear market that began in 1968 and extended to 1982. That was a 14-year bear market.
Yeah.
If the equities analysts and the stockbrokers didn't have specialized expertise, they did very poorly. Now, it's worthy to note that in that same period of 14-year equities bear market, that Buffett earned between 22 and 25% compound annual rates of return in the stock market. It was possible to do very, very, very well, but you didn't do it by buying the Nifty 50, by buying the stocks that had done well in the middle of the period of the 1960s. And I'm not sure if we have another 14-year equities bear market, what sectors relative to others will do well, although I suspect that the first part of that epoch would see natural resource stocks do well.
Exactly. So let's get into that. Let's go into the gold miners and kind of, the argument I hear on social media is that the run up in the gold miners or silver relative to gold might not be as extreme this time because a lot of the capital now goes into Bitcoin or MicroStrategy or XYZ coin, whatever it is. And there's, especially the younger generation, they see more juice in that type of bet. And that takes the purchasing, or that takes that capital away from what would have gone into the miners. So what's your view on, how it's worked in the past, the mechanics of why it's worked, and then if it will work today?
I think alternative strategies will cause some disintermediation from traditional stores of value, but I note that the market capitalization of the precious metals sector and the market capitalization of the crypto sector relative to the totality of savings and investments in the world is about as germane as a pimple on an elephant's behind.
Right.
These are markets relative to the total size of capital sloshing around the markets that are irrelevant. They're relevant to you. They're relevant to me. They're relevant to that part of social media that doesn't revolve around pornography. But they aren't relevant as a whole.
Okay.
Do they compete with each other as speculative asset classes? Absolutely, positively. As do Beanie Babies and tech stocks and over-leveraged declining neighborhood, I'm being polite, real estate.
Right.
People will always speculate. The idea of something for nothing is extremely, extremely, extremely popular. My suspicion is that we are a very, very long way from that in the gold stocks. I've lived through 3 prior bull markets. And George, I'm not going to opine as to why they behave the way they do, but I can tell you how they behave. The market is led by gold. It's led by the fear buyer. And we saw that beginning slowly in what was probably a dead cat bounce in 2000, 2001, 2002, 2003. It probably recovered from those levels simply because it was oversold and we wore out the sellers.
Right.
But it's begun to pick up steam because of fear buyers. And that's how gold bull markets always pick up steam. I remember you and I having a discussion in 2023, and you said that some of your listeners had expressed frustration because the gold price was moving up, but the gold stocks weren't.
Yeah.
The simple explanation, which was true, was that the gold itself was moving up because foreign central banks were the buyers, and they don't buy stocks.
Right.
An asset class that didn't have a bid, of course, underperformed an asset class that did. But like in all prior bull markets, 2 things happen. The gold price increase, when it occurs faster than the increase of the cost of producing gold, leads to expanding profit margins for the biggest and the best producers. At the same time that the momentum established by gold validates the narrative for investors. And that's what we've seen. We saw no increase in interest in gold until about 18 months ago. And then we begin to see blowout earnings from the really efficient producers, the royalty and streaming companies, and the best of the best producers. And in the last 18 months, we've seen the best of the best basically up 100 or 150%. We have seen The largest, most liquid companies that reported earnings quicker and that are listed on major exchanges, proxies for the metal, increase faster than the metal. What happens at this stage of the market now is that value arbitrageurs begin to see valuation disparities. They look at Agnico Eagle relative to something like Kinross or some intermediate producer. And they note that one trades at 1.2 or 1.3 times NAV, while the other trades at 70% of NAV. And the value arbitrageurs begin to go down market. So leadership goes from the best of the best to the best of the rest. And by the way, if it doesn't, mining's a capital intensive business. The guys that trade at higher multiples take over the guys that trade at lower multiples if the market doesn't erase the disparity. As that momentum begins to attract the attention, not merely of gold investors, but attracts the attention of the generalist investors, the market goes further down the quality trail to the single asset producers, to the developers, to the explorers, to the penny dreadfuls.
Right.
And somewhere, by the way, to get to your question, when the generalist investor comes into the space, attracted by the momentum, when the price action justifies the narrative, silver takes over leadership. I've watched it happen three
From the
times
miners.
before. Silver itself, and then the silver miners.
Oh, no, but I'm saying, so usually it goes gold first, gold miners, then silver,
then silver
then
miners.
silver miners. And then once
and
they're
by the
going
way,
up,
when that
then
happens,
yeah, go
you
ahead.
won't need Rick Rule to tell you it's happening.
Yeah.
When silver starts to move, there's no mystery. It's dramatic. You're not concerning yourself from a move from 36 to 39. You're talking about truly amazing moves. Our mutual friend, Doug Casey, describes the circumstance where the generalist investor comes into the silver silo, in particular the silver equity silo, where the market cap is too small to contain the money. He describes it as attempting to siphon Hoover Dam through a garden hose.
Right.
I've seen it 3 times before in my career, George, and I'm eager to see it one more time.
Okay, so that makes a lot of sense. And I would assume same thing with the gold stocks, that
Correct.
once you go down that value chain, if you will, the liquidity dries up. Therefore, the buying makes the price just completely skyrocket because it just
for the hyper speculators, the population of reasonable quality silver stocks is so small relative to the gold stocks that the move is exaggerated.
Right.
And interestingly, and you've seen this as a trader, the price action itself comes in the psychology of traders to justify the narrative. And despite the fact that the silver price may double, making silver as a standalone asset class more attractive, the validation of the narrative means that people pile on.
Right.
In a way that they wouldn't if they were buying physical goods. I'm not sure why people are that way. I've just noticed in the last 3 bull markets that they have been that way.
Yes.
Financial assets are really odd. They seem to be the only, and I describe them as a psychological consumer good. They seem to be the only consumer good that increases its appeal as the price increases.
Yeah.
Again, I'm not sure why that is. I just know that it is true.
I think you hit the nail on the head, Rick, and that it's all about the psychology and the fact the price is confirming the narrative, and then you get the feedback loop where the higher the price goes, the more correct the narrative is believed to be, and therefore the more people pile in, and then you just get FOMO until you get like a blow off top.
I guess that's correct. My background is as a lender, as a credit analyst, and I'm very concerned about values. I remember my late friend, Jim Dines, who was a student of investing psychology, said, Rick, your problem in markets is that you think. You shouldn't do that. You should look. Don't think, look. Now, I'm psychologically incapable of that, but I understand the concept.
Yeah, I mean, that goes back to value versus trend following,
Correct.
and
Correct.
that's a whole other rabbit hole, but very, very interesting topic. Okay, Rick, I wanted to go over AI and how that's likely going to impact commodities, energy. I had this discussion with Chris Martenson the other day, and he was talking about the potential solution being natural gas, but unfortunately now I guess we just did a deal where we're going to ship a lot of our natural gas over to Europe for some reason. So he went over the demands from AI just over the last 2 years, and how we have seen not only increasing demand for energy, but what I didn't even know, a huge increase in demand for water, which I think is one of your favorite topics there. So assuming we get an exponential growth curve in the use of AI, they're building out all these massive, massive data centers that the headline is that they take more energy than the state of Colorado or whatever it is, But what people don't talk about is everything that goes into the data centers, everything that needs to go into the build out of the grid if we're going to maintain our standard of living, and then everything that goes into the cooling process. It seems to me that we got to make a choice. Either we're going to have AI, but yet we're going to have to dig a lot more holes in the ground, or we're not going to dig those holes in the ground and we're not going to have AI, or we're going to have AI and we're going to reduce our standard of living.
I think three things are going to happen. One, in addition to AI, and we've talked about this before, George, there's 1 billion people on Earth who are very poor who have no access to electricity at all.
Yeah.
And we're going to fix that. But it's going to require massive investments
Right.
in energy generation, in transmission, all those things. At the same time, AI and other aspects of data and technology are going to increase demand for power, in particular, clean power. I think it'll impact copper, it'll impact rare earths, it'll even impact tin, which is used for soldering, all these little things.
Yeah, that's one you
It
never
will
think of.
certainly impact nuclear power. It will certainly impact peaking power, which is a fancy way of saying natural gas. I think it's important to note that markets will work, though, as the increase in demand for all of these things overwhelms supply and the prices start to run. We will find ways to utilize resources more efficiently. We will do that. There will be an adjustment. Markets always work. The mistake I made in the decade of the 1970s when all the commodity prices went crazy is I forgot that markets worked. I extrapolated these lines to infinity. By the way, so did the US government, so did the Royal Bank. I wasn't alone in that. I've learned a lesson, and I suspect that this is a problem that the market will resolve in itself over the long term. I'm not suggesting that the impact on commodity prices and the prices of commodity producers won't perform extremely well in the decade. It will. Even in some commodities like copper, if we just maintain current demand, we've underinvested in copper exploration for so long that we're going to have supply shortages.
Right.
You layer on top of current demand the urbanization of 1 billion people in the third world and AI demand, and it's a very, very interesting thing. But I don't take a catastrophic view of it. At age 72, I've learned that people are amazingly inventive and that markets work. While we're on the topic of AI and the AI phenomenon, I want to say that for individuals and for some companies, AI is beginning to stand for artificial idiocy. It is, in its own sense, an undirected search engine. And if you don't constrain the question that you ask AI, I'm playing with it a lot, by the way. If you don't understand the question that you ask AI, what it does is it assembles a whole bunch of misinformation from a whole bunch of sources. If you ask it to do analysis, it searches for consensus among CNBC, ABC, CBS. It's the same sort of BS that you might get from a normal search engine. When I use it to do securities analysis, and I constrain the search to the Canadian Securities Commission database, EDGAR or CDAR, and I use it for comparative financial analysis, it does an astonishingly good job.
Right.
If I ask it to search for variables, but I constrain the search ellipsoid to good sources, and I keep it away from narrative, it does a superb job. But when I look at what Grok does on X, where rather than sorting for fact, it's sorting for opinion through the 600 million users of X, the answers to some of the questions that I pose it are completely hilarious. So I want to, when people are looking at the brave new world of artificial intelligence, understand that improperly construed, AI can also stand for artificial idiocy.
Yeah, One thing I did on, or I've done on a couple live streams, is I actually debate Chat GPT on on certain like macro things, and I'll just completely destroy it, like completely destroy it. But to your point, when I take the time to actually train a GPT,
Yep.
then try to debate it, then it's really 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 good. And there's no doubt that it takes micromanagement, and then once you micromanage it, then it yields fantastic results, or it can help you write, or do all these things. But it's definitely not a panacea as of yet. But I do think that right now it's the worst version that we'll ever have,
Yep.
and
Agreed.
it's only
Agreed.
going to get better. So what I'm trying to do in my own business is just trying to think about, where is it going to be in 2 years, and then I'm trying to build my business around not where it is now, but where it will be. And hopefully that's a good move, but we shall see. But I think the bottom line is still the same here, that I'm more so bullish on the energy than just Nvidia, because I don't know how to play that, and it's like playing the gold mining guys versus the picks and shovel guys. You probably want to bet on the picks and shovel guys, and but then to your point, I mean, I live in Colombia, and I see the economy here just completely booming now. Whether it is in Medellin, whether it is in Colombia, I don't know. But your point is that people go from a scooter to a small car to a Hilux to like an SUV. And then this requires all of this energy. And if you're bullish on emerging markets, I think you have to also be bullish on demand in addition to the AI. But I guess the main takeaway there, Rick, is you would assume prices will go up because increasing demand and limited supply. That supply takes a long time to come online. But once the prices do go up to a certain point, then we are going to figure out how to utilize those scarce resources more efficiently. And then you would expect to see prices come back down, or at least revert to a mean. Is that fair?
I think that's absolutely true. As an
Okay.
example, it would appear that the power source du jour in North America for AI is nuclear,
Mm.
a technological solution, as has been borne out by the large tech companies, the Amazons and the Microsofts, being willing to pay twice the market rate for non-carbon generating baseload power that they have priority access to. What will happen as a consequence of that is that, we haven't built a new nuclear power plant in the United States of any consequence since 1982.
Right.
We're not very good at it. But as we begin to build them, as we begin to implement new technologies, incorporate small modular reactors, in some application larger than a nuclear submarine, the cost of building nuclear power plants, the cost of operating nuclear power plants, ultimately the cost of the power that we generate will come down. Two, the U.S. grid, the distribution grid, is old and creaky. I've heard estimates, interestingly, from Chinese sources, that the U.S. grid, in order to make it addressable and responsive, would require an $8 trillion upgrade. Once that's done, power becomes wheelable, addressable. In other words, market prices for electricity can vary according to supply and demand. If you have solar in your house, as an example, you could be a generator at some point in time and consumers another point in time. The benefit of this will be felt 10 years from now or 15 years from now. Getting from here to there is going to be a challenge. But the truth is that markets will work.
Yeah.
Technology will find a way through this.
Yeah.
It's just not going to be pretty from here to there.
On the topic of nuclear, it takes us to uranium. What I know what your long-term view is of uranium. Why has the price not moved as much? Maybe the spot price has, but I own your old trust, and the price, I'd have to look, but it hasn't gone up as much as I would have expected. So why do you think that is?
Uh, Technically, the reason is twofold. The trust is geared to the spot price, and the spot price is becoming increasingly irrelevant. The trades are beginning to take place in the term market, which aren't reflected in the spot price. It will matter to producer cash flows, but it doesn't matter to investment psychology in the near term. The second and more proximal reason is because the pace of Japanese restarts has been slower than the Japanese have indicated. You will recall that the real decline in uranium prices accompanied the shutdown of the Japanese nuclear fleet post Fukushima.
Right.
The second largest consumer of uranium in the world went away. And the Japanese, for strategic reasons, had always maintained about 3 times the level of operating inventories that the rest of the world had. When the Japanese announced that they were restarting their nuclear fleet, all the analysts, myself included, said, wow, all of that inventory, which is now held for sale, is going to begin to be held for fuel, and we're going to begin the restocking procedure on 40 nuclear power plants. Well, they've restarted 12. They've announced that they're restarting 40. And what the Japanese utilities have done is rather than sell their inventories, they've leased them. In other words, they know that they aren't going to use the inventories for 2 years or 3 years or 4 years. Rather than sell that inventory, they've leased the inventory. They've allowed other utilities to use the uranium in their own fueling cycle with the caveat that they have to pay back in uranium as opposed to paying back in dollars. And I would suggest that the demand boom associated with the Japanese restarts has lagged. As the Japanese restarts occur over a longer period of time, the demand for uranium that has been postponed will resume. I also think it's extremely important to understand the very, very, very rapid pace of new plant construction on a global basis. And the fact that a US plant that isn't taken out of production as scheduled, but rather is extended, is maybe more important than a new build. A
Right.
new build generates demand 6 years from now. A canceled shutdown stimulates demand right now. The third thing that your audience needs to know about nuclear power is simply the importance of the term market. There's no commodity in the world that I know about where producers and consumers can enter into a contract that specifies volume and terms for a long period of time. If I'm doing securities analysis on a gold producer, I have to make assumptions about the gold price 2 years from now, 5 years from now, 10 years from now, that are basically suppositions on my part. If I'm analyzing a uranium producer that has a series of contracts with credit grade counterparties that have to have the material to generate power, a Tokyo Electric Power, a Duke Power, those contracts can spell out for me, if they choose to release them to me, the volumes that will be sold 10 years from now and the prices that those volumes will be sold at. That means that I can know with a much greater sense of certainty the sales of the uranium producer, and to some extent the margins of that same producer, at least to a higher degree of certainty than exists with any other commodity in the world.
Mm.
I would suspect that over 10 years, the uranium producing industry has the lowest cost of capital of any commodity producer, simply because of the certainty around the price and terms of the selling price of the commodity in the out years. And there's not one uranium speculator in 1,000 who is paying attention to this.
Can you explain that further? Because I think that's really interesting, and I want to make sure that not only my audience is following that, but I'm following it as well.
Let's say that you and I are having a debate about what Exxon is worth.
Okay.
That debate involves your assessment and my assessment of what Exxon can sell oil and natural gas for 5 years from now, 7 years from now, and 10 years from now.
Right.
And we don't know. I mean, the first 2 years can be expressed in the commodities markets, but the out years aren't expressed at all.
When
By
you say the
contrast,
commodities markets, you're talking about the futures markets?
yeah,
Okay.
yeah. The commodities markets, except for private derivative contracts, don't extend out beyond 2 years.
Okay.
In the uranium market, Cameco or Kazatomprom, big producers, but increasingly small producers, can enter into purchase and sale agreements for uranium that can extend out as far as 30 years
Oh, so basically futures contracts that go out 30 years.
between counterparties that are private contracts, not exchange traded contracts.
Okay.
And if you have a credit grade counterparty, this is a contingent liability on their balance sheet. It's a secured credit. And that means that while you and I have no idea what Exxon will sell oil for in 10 years, we can have an absolute sense that Cameco will be selling 60% of the uranium that they produce, or some number, let's call it 20 million pounds, and that they will receive a price that's fixed in the contract 10 years from now. So when we look at what Exxon's revenues will be and margins will be, we're making an implicit guess as to the oil price.
Right.
When we look at Cameco, by contrast, we are looking at a stipulated price and volume contract with credit grade counterparties. We have a much greater, not a perfect degree of certainty, but a much greater degree of certainty. And that certainty, if I'm a lender and I understand that the price and volume is sufficient to retire my loan, gives me the confidence to extend better terms on the loan. Similarly, if I'm a lazy equities analyst, say Rick Rule, and I'm trying to establish net present value 10 years out, and I know the selling price of the product and the volume of the product that would be sold, it is much easier for me to do a discounted cash flow model on Cameco than it is on Exxon. The consequence of that is that I can price the security aggressively with much more certainty.
And then how does that impact the price of the underlying commodity, uranium?
I would suspect that it will, over time, reduce the volatility. I'm not sure that it will mess much with supply and demand. What it may do is make the financing more available for nuclear power plants. If, let's say, George and Rick, we're going to establish George and Rick's spectacular nuclear power plant in Medellin.
Yep.
And it's going to cost us $8 billion to build this plant. And George and Rick's balance sheets are a little short of the $8 billion. So we got to go borrow 5.5 or 6 of it. If we have managed to secure enough uranium to operate the power plant, have access to the electricity for a period long enough to amortize the loan, the lenders, assuming that we have an outlet for the power, might be more inclined to lend us the money to build the plant because they know that we'll have access to the feedstock to at least amortize the loan. So one would expect that this term market will lead to greater certainty in the supply of debt capital, at least for nuclear power plants, and in that sense, stimulate demand.
Yeah, that makes a lot of sense. So basically, just so the audience is following there, your main input cost for a business is predictable out 30 years. So that makes you a far less credit risk when you can sit there and say, okay, well, I'm going to be selling it for this, and I've got a locked in price. It's basically like having a 30-year fixed rate mortgage. And then looking at that, the rental income from that property, and you're a much lower risk if you've got a 30-year fixed rate mortgage as opposed to a 2-year adjustable rate mortgage.
Particularly if the obliged party, the utility, is investment grade.
Right.
That, if the contract is with, as an example, a trading firm that is not a credit grade counterparty, the contract is of less value. But if the obliged party under the contract is China General Nuclear, or Tokyo Power, or the Southern companies, that's a very good piece of paper from a lender's point of view.
Right. So more capital, easier lending, therefore more plants go up, and therefore more plants going up to satisfy the demand for energy. Then that means demand, or more demand for uranium, then the price goes up. Okay, yeah. So I think people are able to connect the dots there. Rick, but one issue in creating a plant or a factory or starting a business, any of these things, or digging a hole in the ground to get out more copper, is regulation.
Right.
So I've always tried to incorporate that into the analysis on the supply side, maybe the demand side as well. But can you tell us the story of Battle Bank and the regulatory hurdles? I want people to understand this, because I think the average Joe and Jane that is a W-2 employee, or maybe they have a small business, they really don't understand the degree to which regulation can slow down economic activity.
So I guess the story really begins in 1999 when Frank Trotter, who was the CEO of Battle Bank, started something called Everbank. The regulatory process in 1999 was such that, if my memory serves me well, preliminary application to the granting of a charter took 19 months.
Right.
Fast forward, or slow forward, to 2021, we had sold Everbank, uh, tidy profit for everybody. We built a great big bank and sold it. We were starting a new bank, and the regulatory process that had taken us 19 months in 1999 took us 54 months and counting, to the extent that rather than start a new bank the old-fashioned way, a de novo bank going through the regulatory authorities, we've actually just gone out and bought a bank. And rather than applying to start a new bank, we've asked the Fed's permission to overcapitalize an old bank, something that we suspect that they'll say yes to. What was interesting is that at no point in time did any of the regulatory agencies say any part of no to us. They just didn't say yes.
Right.
I don't know that the statistic is true, but I was told that there were 122 banks in the process of attempting to acquire FDIC certification last year, and two of them succeeded. So
Wow.
Frank and I looked at each other in our 70s and said, "So 120 divided by two, that's 60 years." And the answer to that is hopefully, but likely not. So it made sense for us to buy an existing bank. And I'm delighted to say that we're now basically negotiating the wording of the acceptance. So we hope to be open for business soon. This will tell would-be entrepreneurs in highly regulated sectors. And by the way, given the abuse of the banking sector, it probably needs to be highly regulated. But you really need to take into account this circumstance. I would argue that in some senses, the incumbents are often too lightly regulated.
Right.
As an example, they allow the incumbent banks, and I understand politically the reason why they do it. They allow the incumbent banks to hold long-dated debt assets on their balance sheet without regard to market. They allow them to say that they're going to hold these things to maturity. In a bond that's selling for 60, they allow the banks to value it at par. I don't think, let me just say, if I was a regulator, that accounting practice would change.
Right.
And I'm not suggesting that in the circumstance that exists today, where the federal government provides federal deposit insurance, which is a huge subsidy to banks, that the banks should be immune to regulation. I am suggesting that there's a huge disconnect in the regulatory agencies between the politicized tops of these agencies, which are very frustrating, and some frankly very hardworking, very impressive men and women where the rubber meets the road. As you know, George, I'm inclined to be anti-government. And I need to say, at the lower levels that I have dealt with, at the Fed, the FDIC, and the Office of the Comptroller of the Currency, I've met 12 or 15 people I'd love to hire.
Mm.
I suspect that my problem with those agencies has been at the top, where there's a lot of political inaction.
Yeah, that makes sense. So the bottom line there is the big banks are probably too lightly regulated, and the small banks are the people trying to enter the space. There's way too much regulation, red tape
Yeah,
that creates an artificial, almost like corporatism or crony capitalism, where it creates a moat around these big banks to where it's extremely difficult to compete, which obviously the big banks are incentivized to create that moat in
right.
whichever way they can.
And I'm not going to accuse the big banks of being the authors of my problem. I would only suggest that the nation needs more community banks, that the nation needs banks that are accustomed to the needs of a specific set of clients.
Yep.
At Battle Bank, we seek to be a community bank where community isn't defined by geography, but rather by a mindset, a self-actualized individual that wants control over his or her financial freedom. And I think the idea that there are banks that are organized around certain constituencies is good for the country, but it is tough to regulate. So I understand that.
Yeah. Did you see the interview with Richard Warner and Tucker Carlson?
I didn't.
Okay. So do you know who Richard is?
I do.
Okay. So Richard's a buddy of mine. He spoke at the Rebel Capital Summit, I think in Houston. He was there with Ron Paul. Really good guy. And just for the audience, he started his career in Japan, I believe in the late 80s, early 90s. And he actually invented QE, or the concept of QE. Now he says that it's been completely distorted now to where he wouldn't want to put his name on it. But he was kind of the guy that first started analyzing how commercial banks, the interplay, let's say, between the economy and commercial banks, and some consistencies or some common denominators with economies that do extremely well versus economies that don't. And one of the conclusions he came to is that economies that do well often have a lot of small community banks.
Right.
And his hypothesis was, because you know everybody. And so you know if they're a credit risk, Jim, your kids go to the same school, and you go to the same church, and you understand his business. And on top of that, if you do give him a loan, you're going to keep it on your balance sheet. You're not going to sell it to Fannie and Freddie, or you're not going to, sell it to Wall Street. And when you have this type of dynamic, then capital goes to where it needs to go in order for more goods and services to be produced as efficiently as possible. And let's also remember, when the bank is lending, they're creating new currency units. They're creating new money. And so if they're able to create new money as a result of giving Jim, your buddy from church, the loan so he can create more widgets, which is what you would be incentivized to do because you got to keep that debt on your balance sheet, then this creates this environment where society at large gets richer because we're creating so many more goods and services, which at the end of the day is the definition of wealth. So, but in what you're doing with Battle Bank is the same thing, but virtually, where you're getting to know your customer to the point where you can determine whether or not that's going to be a productive loan. And if so, then you keep it on your balance sheet, by the way. And then because you know your customer so well, because you're focusing in on a certain demographic and a certain target market, then this hopefully will lead to the type of productivity that will not only be great for your customers, great for Battle Bank, but great for society at large.
And I would argue too that there's less risk of catastrophic failure.
Right.
Big banks, by their nature, probably loaned 1,000 different industries, and I would argue that they can't know 1,000 different industries.
Yeah.
Our bank will lend against asset classes that we understand very well. It amuses me that there's no chartered bank in the United States that will make what's in effect a margin loan against physical gold and silver. Some will. JP Morgan Chase will, with a $10 million minimum. They've ignored a fair bit of the market that's important to us. I consider gold and silver to be good asset classes.
Right.
If I have the collateral in my possession and I can sell it 24 hours a day, 7 days a week, collateral doesn't get better than that. In addition, both Frank and I have been talking to the gold community for 50 years. So our customer acquisition cost is very, very, very low. The probability that we're going to suffer a catastrophic failure at Battle Bank, lending to people we know against an asset class that we understand that's extremely liquid, is basically nil.
Right.
The point is that the specialization that's offered up by community banks, even if the community is defined by need as opposed to by geography, makes the banking industry as a whole more responsive to society while simultaneously being less risky.
Yeah. If we increase regulation, if we don't, this is like, you go back to your story with Everbank and you go back to your story with Battle Bank, and you could have given up, right? A lot of people probably would have given up after however many months or years that you tried to get this going. And if you would have given up, then those people that want to have leverage on their gold or use that as collateral, they wouldn't have that option.
Correct.
The people that you served by picking up after, no more than 5 rings, those people would not have gotten that customer service. There wouldn't have been that bank there that would have known their customer to the degree to which you have. So it's not just Battle Bank, it's not just Everbank, it's reducing the regulation. So we have all of these new banks that are able to come in and actually compete with Battle Bank, for heaven's
Right.
sakes, on serving the customer and doing whatever it is that they want and whatever types of loans that they actually need. But if we have all of this regulation, and this is just a proxy for manufacturing and the whole United States economy, but if we have all this regulation, then we get fewer and fewer and fewer banks. You get a monopoly, and then everything, the services, the customer service, the products they offer, it just completely deteriorates to the point where you might as well be doing business with the government.
There has to be 1,000 constituencies in the United States that are ignored by banking institutions. And that means that there's 1,000 opportunities for entrepreneurs to start a business that serves the community better and, oh, by the way, makes them rich. George, banking is a really, really good business if it's done right.
Yeah, but it's instrumental to the economy.
Correct.
I mean, that's what
What I'm
it's
saying is that
yeah.
you don't do it just out of the kindness of your heart. It isn't just a philanthropic activity. I completely agree with you that banking is the heartbeat of capitalism. It's also a superb business if you don't make mistakes, if you don't lend long and borrow short,
Yeah.
if you don't underwrite loans in industries that you don't understand, if you service your customers well and don't take your customers for granted. The idea that you take money in at the current deposit rates, call it 4, and lend that money out at prime or prime plus, uh, and you do it with 10 to 1 leverage. If you don't make mistakes, it's a superb business. It's one of the few businesses in the United States where you can expect a conservatively run institution to generate 15 or 20% after-tax returns on capital employed, where that money can be reinvested in growing the institution for 5 years or 6 years or 7 years. It's one of the finest compound internal rates of return business in humankind
Yeah.
if you serve your community well, if you provide benefits to society.
Absolutely. So let's go from talking about a good business to talking about a horrible business. And this can be these junior gold miners. Let's go back to the beginning of the conversation really quick here.
Yep.
And I've got some buddies in town that I had dinner with over the weekend, and we went out and had a great time. And I was introduced to kind of like friend of a friend. And this guy and his business partner, real sharp guys. And they're actually in the I don't even know if you'd call it junior gold miner, like the super, like the exploration
Yep.
side of the business. So what they did is they went. What's the big mine down in Marmato that's publicly traded that you know about?
It's called Aris mining,
Aris.
ARIS.
There you go. So I didn't even know this, but they have another operation up north of Medellin, in a
Segovia,
town
yeah.
called
Segovia, yeah.
Segovia. There you go. I had
Yeah.
to actually write it down because I'd never heard of it. And so what these guys did is they saw the land they owned, the publicly traded company. And so they went out and tried to buy some land on the exterior of the land because it's so rich. Because their theory is that they buy this land and they start drilling, and they're going to start drilling toward the public mine, that they're going to be able to get really good rock. So it was just really interesting talking to these guys. And I know how speculative it is. And I think that they actually just went public on the Toronto Stock Exchange, these guys I was talking to, and they just started drilling. Like the day we had dinner, which was Friday, they just started drilling. And then I asked them how it was going on Monday, and they said, not so well. I'm like, well, what happened? And they're like, the drill bit broke. So now they got to wait like 2 weeks to get another one. But I thought you'd really get a kick out of that story.
For the benefit of your audience, George, I've been in public markets around mining for 50 years. And I would suggest to you that of the 3,000 public companies worldwide who purport to be mining companies, probably 400 are viable,
Yeah,
which mean
actually,
that 2,600 are non-viable. This belies the fact that in a good market, those 400 generate such returns that they add legitimacy and sometimes even luster to a sector where 85% of the listings have no value whatsoever.
Yeah, yeah, to the other
It's
2,600.
important to note that. So it's very much a business where if you aren't going to do your homework, don't get in the business.
Yeah, right. For sure. All
If
right.
you are going to do your homework, it's an astonishing business. I mean, the drill hole that they're talking about, one drill hole, which might be a $20,000 exercise, can generate $2 or $3 billion worth of wealth.
Yeah.
The odds against that are very, very, very long. So you need to choose the people who plot those drill holes extremely well.
Yeah. All right, buddy. Tell us how we can find out more about what you do. Are you still doing the thing where you're analyzing people's gold stock?
Yeah. Yeah, George,
Okay.
I failed retirement completely, thankfully. So if you care what I have to say about natural resources, particularly if you want to find out whether one of your mining stocks is one of the 400 real ones or one of the 2,600 fake ones, I'll help you with that. Go to my website, ruleinvestmentmedia.com. List your natural resource stocks. That's ruleinvestmentmedia.com. List your natural resource stocks and I'll rank them 1 to 10, 1 being worst, best, 10 being worst. I'll do it for free. Be patient. I'm about 250 rankings behind. If for any reason, I can't imagine what it would be, you are uncomfortable with your current bank. As an example, if you're interested in getting paid interest, which I think you should be, or if you're interested in borrowing against your gold and silver or having access to credit against your gold and silver, if you think that your IRA should be your IRA, not a toilet that you put annuities into, go to battlebank.com. Or if you don't want to do that, when you've submitted your stocks to Rule Investment Media, just write bank in the question and comment section, and we'll get you up to speed on Battle Bank. Failing that, I look forward to seeing any of you who care at a Rebel Capitalist conference, assuming that George invites me back.
Oh, definitely invited back. And I'll see you soon here in New Orleans, buddy.
Look forward to that.